Good morning and welcome to the Monday Market Update. My name is Nash Paradise, and here with me, the dude himself, Mr. Andrew Cady. Thank you for joining us, Andrew. How you doing today?
Doing good.
All right, brother. Let's get right into it. I know it's a holiday weekend, so a lot of people are doing their things. You're going to come back and see this later, so want to give them some quick, flashy info. What happened? What's going on? Where we're going from here? So, getting into last week. Man, that chart looks pretty. I love the way that looks. A little down, a little down, a little down. Started at 615, ended at 6.04%. Getting down close to the 6% mark again is a great place to be. We're calling it medium high volatility. Anything you'd add to that?
No, I think it was a great momentum week. Broke through a lot of levels of support. I think we're in a good spot right now.
Yeah, man. What you don't see on this is where the 10-year Treasury bond finished, and that's 4049. So seeing that, we had a threshold at 4.2, another one at 410. So seeing the 10-year bond moving around is great for all of us in the real estate world. So let's talk about what happened last week. Getting into the data. All right, so we had a few different days of pretty important stuff, and the big one that jumps out to me is Wednesday. Wednesday is Jobs Day, Labor Day. You can basically break up a lot of what we talk about into either labor or inflation. And ultimately, those two things move the needle a bunch. So, rates got a lot better last week. So we must have missed hard on labor, right, Andrew? Did I lose Mr. Cady? He's all frozen.
Everything froze there for a second.
Okay. Hey, yeah, you're back now. I thought you were just thinking really hard about my joke on missing on labor. But
no, the whole screen went black there for a second. No, so we didn't miss on labor. Labor actually came in stronger than estimates. Unemployment rate went down. Lots of job gains. So, and ironically, Wednesday, the markets kind of shrugged it off. It started off volatile, but we stayed under the 420 on the 10-year. By the end of the day, the markets had shrugged off the entire jobs report having a big win.
Now, Andrew, for the loan officers listening, and you know how loan officers are, why is it that when jobs are strong and come in way over estimates like this, unemployment rate goes down, why do interest rates typically respond by going up? Why is that the natural response in the bond market and then via that to MBS Treasury? Why are good jobs bad for rates?
I know. We're in an industry where we kind of celebrate the bad things. Yeah, so if we have a really strong labor, so as we know, the Fed has a dual mandate. Their mandate is maximum employment and price stability. So inflation and labor. Obviously, we've talked at length that right now their focus seems to be heavy on labor because the labor market is showing signs of weakness. If the labor market starts to turn around and is strengthening rather than weakening, that would put into question whether additional Fed rate cuts are happening this year. It's going to push the timeline out. If we continue to see gangbuster job reports, well, it would push the timeline out for rate cuts. Why? Because the Fed is no longer going to be as concerned about the labor market. So that's why you typically see interest rates react negatively to a strong jobs report.
Yep. So if jobs are good, you don't need to reduce the costs for businesses, the cost for anyone, cost for consumers. But ultimately, when you reduce the Fed funds rate, that is a pass through savings to consumers. It is, banks, it is, lines of credit. It's for, if you make life cheaper, businesses can hire more people. If there's a lot of jobs out there and a lot of people are moving money through the economy because the labor market is strong, people are having to pay more for help. When labor is strong, money gets moved around at a quicker pace and inflation tends to go up a little bit. So what are you not going to do? You're not going to lower the Fed funds rate. You're not going to see lower interest rates. They're going to hold steady or, sometimes even go up a little bit depending on that. So that's why when jobs are strong, mortgage rates tend to bump up a little bit because that's indicative of, hey, keeping expenses a little bit higher because things are great. When jobs are weak and rough and companies are doing lots of layoffs, the Fed in their mandate lowers interest rates, tries to drive down the costs of doing business, which can improve, stability for businesses, help get more jobs. So we should have seen, a pretty decent increase on Wednesday. But like Andrew said, markets seem to just shrug it off, and they took that one on the chin, no big deal, and then immediately turned around. Friday was a big news day. That was the one I was watching. This is this is inflation day. We got month over month core headline, core CPI, and Andrew, how would you describe these four ultra red bars here on importance? What happened on Friday?
Friday CPI, we had a miss, which was a miss to the downside, which was really amazing. Previous if you look at just the overall year over year 2.7% inflation rate, expectation was for it to come down to 2.5, and it came in at 2.4, which is a pretty massive drop off. And really everything across the board. I mean, month over month expectation was 0.3, it was 0.2. We really had a strong inflation report.
Yeah. So inflation's coming down, jobs are going up. We should all give credit to the Fed and the administration. We're not here to talk about who's responsible for that. But all that to say, we're spending a lot of time on what happened last week because this is the information worth sharing.
So
Jobs are strong, inflation is down.
So there is one thing that is kind of interesting when you actually look, when you break down the CPI report a little bit. Airfares actually rose 6.5% in the month of December. And if the airfare increase, which is very seasonal due to holidays, if that airfare increase wouldn't have been there, we would have seen an adjusted year over year down at almost 1.7%. That one tick up of airlines really kind of spoiled the party for what could have been, or sorry, not 1.7, right at 2%. It would have been right in line with the Fed's target. But that 6.5% increase in airline fares really set things off a little bit, which is interesting because we may see that pull back in January and have another friendly CPI report coming.
Yeah. But to that same argument, when we're going month over month stuff, there are some things that are going to be higher in 1 month versus another. And I think a lot of traders are taking a lot of this into consideration to figure out where is the real stuff here. We also have just some normal liquidation coming up before a holiday weekend. So regardless, we're going to take the wins that we got last week. Last week was huge. And hey, chock full of wins. We'll take it. Let's move forward a little bit and see what's coming up soon. This week, there's a whole lot of stuff on here, but really I'm only highlighting a couple things. Like I said, lots of chat, lots of middle ground, nothing as significant as last week's double banger, but we've got the FOMC minutes on Wednesday. Andrew, can you describe what that actually is that we're getting on Wednesday?
Yeah, for anybody that's been a part of a big corporation that has like a publicly traded corporation, every single meeting they have, there's a scribe in the meeting taking notes. They're meeting minutes, and it's who said what they said, what was the sentiment in the room, all of this. And the Fed does the same. And they don't release their meeting minutes, immediately after they have a meeting. They're released on a schedule. So we get to actually dive in. We got to see with the Fed last Fed meeting, the decision that was made, and we got to hear Jerome Powell talk afterwards. Now we actually get to see who said what, who had some strong words about what, whether they see a future rate cuts, what they think we're going to see in the future. And this one in particular could be colorful because of the new Fed chair being nominated. this could be a very interesting and colorful set of meeting minutes that could really move markets.
Yeah, I totally agree. This is interesting because of where we are in the year and with the new Fed chair coming up. We do have Bowman speaking before the minutes are released. So that may frame those a little bit. We'll see what he says in that speech. But, Thursday, there's a bunch of more speeches from Fed members. So lots of talking, lots of nerd stuff that most people aren't going to be paying attention to necessarily. We do have some jobless claims and continued claims for the weekly reports on Thursday, and then Friday we're getting more, PCE, a different type of inflation report. If everything holds the line with expectations, compared to last week's, cool. It'll be interesting. It's definitely worth circling. Friday on this chart looks like there's a whole bunch of big stuff on there, and I think it is still big and it's still important. But after last week's data, I think anything outside of just, holding the line is going to be met with some movement, but there's no good reason to expect that not to hold true. Anything else that you'd circle for this week?
Now, to me, there's, like you said, there's a lot of data on these 2 pages. The two for me is the Fed meeting minutes and then the CPI, or no, the PCE, personal consumption expenditures, which is another measure of inflation. In fact, it's the Fed's favorite that they love to look at. That comes out on Friday. Those are the 2 that we got to keep our eye on. I mean, sure, global manufacturing, but the market has really shrugged off about anything that isn't labor and CPI data at this point. If manufacturing came in way off or way high, way low, sure, it could move markets, but the market is tending to shrug off anything and everything other than labor inflation.
Yep, 100%. Let's move on. All right, getting back into the Fed funds rate, not a whole lot to discuss here. Not a lot of extra movement. Maybe a little bit of pullback on when are we seeing that first cut. It's still targeted in June, but not quite as strong a percentage as it has been, which is really fine. We just know like either June or July, we should be targeting for another cut. That could completely change this week once we see the Fed minutes. I think it's a little irrelevant right now. Because we have had enough cuts to be down at a level where there is some stability in this 350, 375 zone. So, will we still likely get 2 cuts this year? Yep. Are we still targeting right now, June and September? Yep. After that, I guess the only other thing I find interesting here is the shift to holding at 300. There have been some charts and some weeks we've looked at here where the hold was at 325 mark and maybe even a bounce back in 2027. And now a lot of the stuff is showing that 275 to 300. Anything else you'd add that was interesting here?
No, I think it's a wait and see until we see what the new Fed chair can do. I mean, keep in mind, this new Fed chair is only one of 9 voting members. So, it's not like everything changes when this guy gets in. Still have to have 4 people to vote with him in order to move things, which I think the meeting minutes could start to open up and see what people are thinking on that. But I think we're in line. A June or July cut, a September, October cut, somewhere in there, and then potentially leading into a nice cut at the beginning of 27 and holding at that point.
Yep. Nice and boring is good. Boring equals stability, and stability equals margin compression. When you have instability, you're going to get a bigger swing in your margins between like the 10-year treasury bond and the 30-year fixed rate. Those have been compressed nicely. We still need some extra G fee assistance and, things that can be controlled there, but stable is good. Stable is something that we can count on. And this nice slow burn that we're looking at in 2026 is still holding. So from here, let's take a look at the pretty chart. All right. Yeah, that's a nice little tweak down. It looks maybe more severe than it is, but it feels pretty good too. That was a very nice late run. My biggest concern is every time we've gotten one of these good runs, it's been on a Friday. And we've had 2 of them now that are Fridays before a 3-day weekend. And I hate that because you see a lot of liquidating before a holiday. And by the time Tuesday comes, if things start moving one direction versus another, it's wheels off and you lost it. It's gone as quickly as it came, which, man, looking at all these small dips in the chart, look at every time we have a nice drop down, almost immediate bounce back. The one in January actually lasted for like 4 or 5 business days, which was cool. Who knows how long this one lasts, but we're here. So I'll take being here versus the alternative. Will it hold? I don't know. What do you think, Andrew?
I don't know. I mean, the data suggests this one could hold, and unless something rocks the markets heading into this week, the data suggests it could hold. You're right on, liquidity matters, and that is something we do have to watch. But I think the real thing that we gotta keep an eye on is if we can pierce that 6%, because that's going to be a floor at this point. And if we can pierce the 6%, I think we've got room to run on it. Otherwise, that 6% could be used as a floor and bounce back off of it. I'm optimistic. I want this thing to hold. I'm ready to see the conversation continue to turn. I mean, it's crazy. We've talked 6% rates for so long now, but let's not forget that is 2% lower than the highs we saw.
Yeah.
It's 1% lower than what we were, a year ago. Like, we're in a pretty dang good spot. So this is good. Let's keep it going.
Totally agree. The other thing I would add on here is, we're talking about resistance levels, not to add one more layer of the nerd stuff in between, but that 10-year treasury bondo. I mean, the last time we had those couple dips in early January, it was not, and we didn't move with the bond market. We moved with the mortgage-backed securities market. That was in response to tweets. That was in response to future, GSE purchases, which, those will be what they be. This drop is aligned with treasury movement. Treasury movement is strong. That is the foundation that we can build a beautiful mortgage market off of, because we know that those things hold true. The MBS will move as the treasury bond moves, and breaking below that 4.0 floor, that's what my focus is right now. That's where I'm watching. I love seeing a 4.049. It's so pretty. It's closer to 4 than 410. And hell, I'm just glad to be away from that 420. But there was a lot of volatility here last week. We've dropped below 4% before on the 10-year yield. I think it's September last year. Did not hold at all. There was no resistance there. Bounced right back up. So to your point, we've got the models. We have the CPI. We have the labor stuff, where if we can get this slide down, it could hold. It could be a very good few weeks in a row. We'll have to wait and see how the market handles everything. And market open tomorrow is going to be very, very important. If you're a loan originator watching this, a realtor, and you've got people in a position to make moves, tomorrow is going to be a volatile day. Be plugged in and get early. Sometimes you can catch that. If there is a little bounce back, you can get in before it becomes too severe. So be on the lookout for tomorrow. Lots of good news coming this week. We'll continue to unpack this on a weekly basis, but I love the downward trend. Anything else you close us out with?
I think we're good. You nailed it. Let's roll.
Love it, man. Always appreciate your time. We'll see you guys back here next week.
Take care.